Hello, everyone. Welcome to a Wall Street from Main Street podcast. And today's special guest is Peter Grandich. Peter is a commentator at MoneyTalks.net, and he was also a guest in our previous podcast. Peter, thank you for joining us.
Always a pleasure. Thank you for having me.
So, Peter, I want to start off the podcast by talking about your background. There may be some of our listeners don't know much about you. So, if you don't mind, could you just give us a quick summary of your background and what you've done?
Sure. For the last 30 years, the first half was spent on the money management side. The last 15 years or so has been spent on a consultant side of the business, as well as running a separate financial planning firm that caters to professional athletes and also the general public. And most recently, at the beginning of this year, I became the commentator for a website called MoneyTalks.net, and that's where I share most of my thoughts on markets and the economy.
What's interesting about you is that you didn't finish high school, and yet you became very successful on Wall Street.
Well, that's correct. Most people take the road of a Wharton School type of business graduate, and I took the School of Hard Knocks road and got fortunate blessings early on. Was moved up to head of investment strategy, forecast the market crash back in '87, and by the early '90s was managing some hedge funds and a mutual fund that bared my name. And so it is not very common for someone not to finish high school and someone come somewhat half famous on Wall Street, but that's certainly the road that God allowed me to travel.
So I want to ask you, how do you feel about college degree and the whole college experience that people go through? A lot of people think you need a college degree to be successful, especially on Wall Street, where a lot of them, as you said, come from Wharton or Ivy League schools. And also a lot of them are also progressive, Democrat and Republicans, and they're all for, bailout, bigger government, and having the Federal Reserve keep interest rate at zero so they can be bailed out whenever they screw up. So I want to get your opinion. What do you think about going to college and getting a degree and then going to work for Wall Street? Do you think that's necessary or not?
Well, I don't know if I'm qualified to speak on it, but I certainly have an opinion on it. I mean, I just finished paying for a daughter to go 4 years and graduate from St. Joseph, and I think it will benefit her. But I wonder for a large-scale amount of people if it's necessary. It's certainly, obviously, you're going to become a doctor or a lawyer. There has to be a higher education process. But for a lot of things, including the business that I went through, I think when I look back at my career, my on-the-job training was far more valuable than anything that could have been taught to me in class. In fact, I think classroom scenarios don't fit into the real world, particularly the world of finance. Certainly, someone has to understand how to read balance sheets, and certainly if you work at higher levels to understand finances. But like I said, I think at the cost of what now it is for someone to go to school, I don't know if the earning power that you get so much more that it ends up being worthwhile. And at the rate that cost of colleges are going up, I don't know how in another generation it'll be affordable to the average person. So I guess I would be more in the camp of, for some it's worthy, but certainly me and I think others who might think they need it, an on-the-job experience to me is proven more valuable.
I agree with you there. I don't think you'd have to go to college to become successful. There's many avenues, other ways to learn. Thanks to the internet, you can, learn to read balance sheet, learn to do modeling, learn how to use Excel. A lot of online classes that are cheaper than going to college.
Well, I think one of the things that's lost, certainly I'm a gentleman that's approaching 60, and I can remember as a young man, certainly for a trade, which is in very need of, there are a lot of tradesmen that really are no longer going to see because the next generation did not go into that area. But back then, most type of trades, at least, and even some businesses had apprenticeships, and that's how someone would start. And really was an on-the-job training program and process that got someone to become a good crafter or become very good in the business world. And I think that's been lost And and I said, like I said, I think that's why we're not going to see many so-called born and raised Americans, building, being carpenters, electricians, and other craftsmen, and even into mechanical engineering and things like that. And that's why people from overseas are taking those jobs, because we're just not training people for that anymore.
And that's a great point. So, what would you tell a young kid fresh out of college who enjoy learning about finance and investing and want to go work on Wall Street? What advice would you give them?
Well, I say this half facetiously. I would say run, not walk away. What I entered in 1984 and what exists now, in my mind, is just 180 degrees opposite. When I entered the business, Wall Street, about 86% of the trading. First, let's take a step back. Almost all the trading was exclusively done on one exchange, the New York Stock Exchange. There was a smaller exchange, the American Stock Exchange, and of course there was the NASDAQ. But what 86% of the trading that took place on all those markets was done by individuals, and most individuals back then were buying what the stock market was for the first couple hundred years, and that was a place where you can buy part ownerships of businesses, and they approached it that way. I think very little of that is done these days in all the various exchanges and ways that people are able to play markets. Many participants don't even know the name or may not even know what the business does, but because some computer spits out some algorithm or some other type of reason, people are buying and selling. So the first thing I think is important for people to recognize: the market that I entered in '84 and the market that exists in 2014 is dramatically different. The other thing I would say to them is, and this is something that I had to learn the hard way and had to suffer losses myself, and that is that what we commonly know as traditional financial planning, or the process that most people go through, is not going to have any real chance of success. And in fact, I would argue that only a small percentage, less than 10% of people that play the market over time make money in it. Now, in that small percentage of people make oodles of money. The problem with that is they're not making it simply because they're good people that know how to read a balance sheet. They're people that have established an information flow far superior than others. And so, all in all, I think it's a much different species that I entered in '84, and I would caution anybody to come in and think that it operates in the manner that it used to 10, 20, or 30 years ago. I just don't think it does anymore.
And I agree with you. I mean, Wall Street, you should be a little bit more productive back in your day when they're investing in business and startups. You're trying to help them grow, provide capital for any businesses that need it. But now they're all about trading. They're all short term, and all about the bottom line. They're trying to get as much bonus money as they can as possible, and they have the Federal Reserve backing them up. So anytime they screw up, they taxpayers on the hook. So the culture has changed a lot due to government. Would you agree?
Yeah, but I think it's gone even worse than that. And where I think it's gone is this recent trading, which basically for the average person to understand, imagine, if you will, that we were thinking about going out to buy our groceries, and someone learns of exactly the list that we intend to buy at the store, runs ahead of us, buys it, and then puts it back on the shelf for a few cents more, knowing that for certain we're coming to buy those very products. Well, that's what all this computer trading has come to, that people were able to, in these milliseconds, which I don't even know exactly what that is, but they were able to front-run orders and be able to profit, and really profit at no risk. And that's where it's gone wrong. I mean, you have to take risk. I mean, there should be risk in something, and there's a select group of people who have minimized, if not eliminated, risk and have tremendous advantages. And that's why I get very concerned when I still meet people in my planning business and maybe walk into their home and see that they have 3 or 4 televisions on and 2 or 3 computer screens, and they're telling me that they're trading their own account from home. And as much as they think they have a lot of information there, I could tell them that people on the other side of those computer screens have far much better information and get it much faster than they do.
And that's a great point. And I think you're referring to high frequency trading
Right.
and the damage it does to traders because it puts them at a disadvantage because all the hedge fund and big banks that have the high frequency trading, they have an advantage over retail day traders. So,
And if you think about it, it just takes away the whole concept of what stock ownership is supposed to be about. I mean, when I started, it was about an opportunity to become part owner in a business and believing that because the business would be successful in what it does, someone would be more willing to pay for your shares at a higher price down the road. None of that takes place in those type of cycles. No one cares about that. It's in fact become a sort of casino. Only in their casino, the house always wins.
and that's unfortunate that Wall Street and the stock exchange had become a casino where people gamble and they lose. And well, for the big banks, they lose. The Federal Reserve bailed them out. So it's kind of sad to see that this is what's happening in Wall Street and in the finance and investing world. So let's move on and talk about the central bankers, which is causing a lot of the bubble that's going on for the past 100 years, pretty much. Especially what's going on in the bond market and even the stock market is still in a bubble. Well, without the Federal Reserve printing endless amount of money and interest rate at zero, I don't think the stock market would be this high as today. So I want to get your opinion. How much longer do you think global politicians, Keynesian central bankers all over the world can keep up the game before a market crash or even currency collapse?
Well, my personal opinion is I don't believe it can go on much longer, only because it's very difficult, if not impossible, to find anything of value to buy now. I know and still speak with and still have friends that have significant positions on Wall Street, whether it's as mutual fund managers or hedge fund managers, who still try to invest the old-fashioned way, so to speak. And in recent weeks, they've all but thrown up their hands to find really other than one or two areas where they could see anything that's even remotely half of valuation, certainly by any long-term methods that they've employed for 20, 30, 40 years. Now, I think we see that because that's why these companies, trading at 150 or 200 times earnings, are still trading up 5 or 10% in a day because it's become so narrow of a focus, similar to what happened in the internet craze at the end of the 1990s before we had a major downturn. In terms of the banks printing the money, inevitably, when just about everybody's in a race to debase their currency, the winner actually ends up being the biggest loser who debases it the most. And that's still up in the air between Japan, the U.S., and a couple other places. But the fact remains now that we're in this cycle where that not only have the debt levels become extreme, but the type of debt that's still moving in the economy is becoming of the highest risk. We all know, although some of us spoke about it and were laughed at in 2006 and 7, when we warned about what was happening in the mortgage and the only reason the real estate market was going up. And if we look back and know what actually happened, because we now know the facts came out afterwards, we had mortgages of great quantities being sold by major financial institutions, knowing full well that the people who they were selling them to or who were taking the mortgage were not going to be able to pay them, to the point where many of those institutions that did the selling actually took the other side and bet on the decline of those mortgages. And what I try to tell the people, and it's still amazing that most people either refuse to grasp it or just somehow think it's behind us, I try to say to them that it would be the same that if we turned on the television tonight and we heard that the major auto companies were building cars knowing full well they were going to crash, and when the person bought the car, they themselves, the auto companies, bought life insurance on them so they can collect when the person dies driving their car that they sold them. And that's exactly what transpired in the mortgage game. And now, unfortunately, it's been somewhat moved down, even further down the food chain of quality, into the auto loan business. And now we've learned, and we saw even in these GDP numbers, how subprime credit has really been the fuel that really helped for the so-called rebound in the GDP. But more importantly, that the auto loans now are being packaged just like the mortgages and being sold by Wall Street groups because they have an 8 or 10 or 12 or 14% interest rate on it for these poor souls that are paying $600 a month for a car loan simply because the only way they can get it when really anybody else with worthy credit would pay $200 for the car loan. And now we're seeing another setup to where the auto business is going to collapse the way the real estate business collapsed, because the terminology for anybody that's in the auto business is called upside down, and that's when a person that has a loan has more outstanding on the loan than the car is worth. And now there's an estimate that over 50% of the cars out there are in that situation. So it's just, to answer your question, and I was long-winded, but to answer your question in a very short sentence, it's not a question of if, but when. And I don't know which country goes first, but it's not going to be just one. My leading candidates are both Japan and the United States.
And if you look at the stock market in general, I read an article on Gearhead a couple of months ago. They said that the stock market is as overvalued as it was in 2007 with a forward PE ratio of, I believe, 15. So we're seeing a lot of a mirror image of what's going on in the stock market now to what happened before the 2009 financial crashes. And you're right, the auto loan industry is mirroring the housing bubble that we had back in 2000. And that's bad for all the auto companies, especially companies like GM that's barely staying alive, and Chrysler, because without the bailout money, they wouldn't be alive today. And I think they're going to go to bankrupt again pretty soon, considering all our vehicle recall that we have.
I think there's another problem, and it will only show itself after the meltdown or whatever takes place. And I see it because I live within the community that is going to be the most hurt by it, and I've reached the age level where I fit in, and that is the 55 and over community. Over these last few years, anyone close to retirement has been chasing yield because of the dramatic drop in interest rates. There is no way that the products or fairly safe investments that used to exist that people could live off of income have gone because they've come so low in yield. And therefore, we have watched a community of people, many who have already stopped working, so their earning power is not going to be there to make up for any substantial losses they may suffer from chasing yield. And much of that chasing went into what is commonly known as the high yield market, or which really is called the junk bond market. And it drove returns, yields so low in these junk bonds that the spread between them and treasuries became one of the smallest ever. And it made me jump up the screen several weeks ago and tell people, that you got to get, if you're not out, you've got to get out of the junk bond market, because what's different there versus treasuries and municipals is not only that municipals and treasuries have more taxing power than corporations are going to have the ability to raise funds to pay off their debts, but you could have a very slow economy because of recession, because of the market tanking and the economy tanking, and maybe bonds don't go up as high in yield, but the junk bond market's going to collapse anyway, because the concern there is not so much the ability of the yield, but the ability for the company to pay off the principal debt. And so I think the story that'll be among the leads when the inevitable downturn comes down again will be not only the tremendous hit that the junk bond market took, but who the buyers of those junk bonds was, and mostly it was people chasing yield, and mostly from the senior community, who, by the way, the 55 and over community controls about 80% plus of all the wealth in the United States. And so if you're going to have a discussion about wealth and markets, you have to look at the age group that owns the majority of it. and the vast majority of it is people 55 and over, and they have just been consumed with chasing yield in order to try to keep their living standards at a level that they grew accustomed to, and they're going to be the people, I believe, that unfortunately are going to be the hardest hit when the inevitable bust comes and rates go higher and abilities for corporations to pay junk bonds off become very difficult.
And if you look at the yield for the 10-year, 30-year Treasury bond, 10-year is at 2.5%, and 30-year at 3.3%. And if you factor in inflation, the real return is negative. So baby boomers are struggling to get a return, and it's going to be very scary down the road how when they retire, how they're going to live off. They may have to come back in the workforce and continue to work just to stay afloat, which is very scary.
If you look at what's happened to them in the last 10 to 15 years, what used to be the three things that they would count on. The first was that their investments will go up, and to some, although we have a lot of divergence even this year where the Dow, may be up in the S&P, but small caps are down, what have you. But they would always be told that, over time the stock market goes up. The second thing they were told was over time their home values always went up, and that's no longer the case. And then the last bastion, which is they're about to just see a dramatic change for the worse for them, is they did have a platinum-type healthcare system, Medicare. And at the time when they needed the most, they could count on an extremely low cost because the government picked up so much of it. Well, that's all going to change. That can't stay. They say you can only guarantee death and taxes. Well, I'll throw in one to guarantee Medicare will not be able to be the way it was for the much more of the foreseeable future. So here we have the group that still controls the vast majority of the wealth, is the single largest voting bloc in America. In fact, now there's more people over the age of 65 than under 18 for the first time in America. And they're getting hit in every which way except maybe the stock market in the last few years, but even that's about to change for them. It's going to be very interesting to see how that group acts in this battle of demographics and nationalities and immigration and all that stuff. We really have a pot boiling of a tremendous mess on all levels and stages, and the complacency, not only in the investor side, but in the professional community, because I hear professional people concur with a lot what I just say privately, but in their public image, nothing is further from the truth as far as they're concerned. And so I just think there's just a basket of things coming that unfortunately are going to paint a much more difficult picture perhaps than anything America's seen in its history.
And we're going through a very scary time in this country. I mean, the debt level has never been this high. Look at the Federal Reserve balance sheet, over $4.4 trillion. I mean, this kind of stuff had never happened before. Well, they've always, gone into debt, but this debt level has never been this high. And we talk about recovery in the economy. This is the longest so-called economic recovery I've ever seen, because this is taking way too long for us to get out of the hole, and we all know why we're never going to get out of this recovery, because there's too many government interference, and there's also a lot of wealth transfer going on from the middle class to the upper class, a lot of inflation, and the dollar is being destroyed. So we're going through a very scary time, and it's going to be interesting to see what happens in the next 5 to 10 years.
Well, there's been a cost, and that is what America can't seem to grasp. We've, like you said, the Fed itself has added over $4 trillion to its balance sheet. There's been somewhere between $17 to $20 trillion in actual debt that's been increased. And for what? This anemic economic rebound? I don't think it was even remotely close to worth it. And we still have a whole bunch of other issues that aren't addressed. I touched on one, Medicare. We didn't touch about Social Security. And that is the entitlement issue. There's a big IOU out there, much bigger than the actual debt that we have. Unlike corporations that by law are required to carry unfunded liabilities on their balance sheet, the United States government isn't forced to. If it was, we would be bankrupt. And that is the terrible thing that most people don't grasp. And one last thing before we'd end the interview, I think it's very important, and this goes to both sides of the aisles. It's not any one party that's just guilty of this. We have not had good fiscal, business sound laws come out of Washington for a couple of decades. I am involved in a variety of business people across the country, from small mom and pop business owners right up to CEOs that run Fortune 1000 companies. And across the board, not only do they keep saying, well, I hope whatever this recovery is supposed to be happening comes to us because we're not seeing it. The other thing that they say is it's become nearly impossible to run their businesses. Over-regulation, a terrible tax code business that makes doing business very difficult, and just so much uncertainty that when you combine all of that, and as we just discussed, all the things that are negative, unfortunately, it's impossible for me as much as I would like to. It's always easier for people to accept it when you speak of the cup being half full versus half empty. But the fact remains in my mind, and I think yours, and I hope many of our listeners, that we have lived way beyond our means for a very long time. And in any way you do it, whether you put on too much weight or you don't take care of a house and eventually it has to be fixed up and a lot of money spent, that's where America sits right now, and that's the road where we're at. And whether it's one day or 143 days more that we go before the bell rings, when that bell rings, it's not going to be just for a short period of weeks, months, or a couple years, but it could be a generation or more that America suffers for the sins of its past.
And I agree. I mean, both parties are not fixing the real problem in the economy. Like you said, high taxes, too much inflation, too much regulation, Obamacare, make it very unfriendly to do business in this country, which is not going to help the job market grow at all. So let's shift gears here and talk about one final topic before I let you go, and that's the gold and silver market. Now, the gold and silver market has been relatively quiet this year. Are you surprised by that?
I guess it would be easier because the average person wouldn't send as many emails or dial the phone if we were higher. But what I don't think they grasp is this: any market that went up for 12 straight years is entitled to correct for a year or two. It doesn't matter what it is. And we basically had a straight-up market since the turn of the millennium in the gold and silver market. The second thing in it, there's so much circumstantial evidence and actual evidence that I don't even bother to argue with the people that say I wear a tinfoil hat or anything like that. We know the market has been manipulated. We've seen just countless times in the last few weeks where on the opening of a market, someone decides to sell $1.3 billion worth of gold as soon as the COMEX, which I like to call the CRIMEX, opens. You just don't do that. I've been in the business 30 years. If I have a big sell ticket and I want to get the best possible price for myself, my client, feed it up, because it becomes a self-fulfilling prophecy and the prices go a lot lower than they would have. So that tells me that there's someone or some group that continues to use this market, knowing it's a barometer, and to take advantage of what happens when they do things like that and the declines that come. The difference has been is compared to 18 months ago when that happened. Now when it happens, sometimes the decline literally only lasts for hours and at most a couple of days. And that's because we're seeing a change and this massive, horrible, and it's been a very horrible correction, but it's a correction nevertheless still in a mega bull market in gold that began in 2000 in silver. And we still have a couple of key points to get above. In the gold market, it's 1340, but most importantly, 1400. And in the silver market, we need to get above 22 before we can say whatever this was is behind us. But it's acting constructively, and particularly I think people need to understand this, and that is people don't buy fire insurance or home insurance and hope that their home burns or something steals their car. But the bottom line is they want something there in case it happens. Well, I always tell people that if you owned gold simply because you want to hope it never goes up, which means that your financial assets did okay, then treat it as insurance. But I think gold and silver has become more than that. I believe it's come an investment. And the reason I believe it's come an investment, not because I'm a crazy and I think the world's coming to an end, is that the people that are making money in the world are treating it like an investment. The people in China and other areas where there's still strong growth in the world, India and all, are treating metals as an investment. When you go to China, their 401k type programs don't put people's monies in stocks and bonds. It puts it into gold and silver. They want a hard asset. They don't trust the paper. Well, they're the people making money. Just as it was 50, 60 years ago, people forget we were once a great credit nation, and everybody tried to do and emulate what America was doing. So I just think where the prices are of gold and silver, relative to what other assets are selling for, they offer tremendous value now. And if you treat it just simply as insurance and hope it doesn't go up because it means that your financial assets done well, and that's another point to look at in the last 2 years for people that say, oh, gold and silver perform poorly. Well, you know, the stock market, we can say it's been manipulated or whatever, has been driven up tremendously, and so much money has flown into stocks and bonds. Well, let me tell you this. If I owned stocks and bonds, I would hate gold too. I mean, if gold does well, chances are my stocks and bonds aren't. So I don't suspect to hear anytime soon from the Wall Street community to be bullish on gold and silver, particularly when what they are up to their necks in is doing well, at least in the perception of it. And so to look for positive commentaries and look for those type of people to be bullish is foolhardy. But I do think we are seeing a very constructive base being built. I think things that were related to it that got crushed, particularly in the mining shares, and particularly if you went into the exploration stocks, they've been beaten to death. In fact, if someone said to me, is there any group that still offers valuations of any attractiveness, it's really one of the only places you can find, and that is in the mining sector. So I'm very, very positive on it. I don't expect, nor have I implied that we're about to rocket it up, but I think everything that's transpiring is constructive, and when that turn does come in the stock market and is evident to just about everybody, it'll coincide with a major breakout in the gold and silver market.
And as long as the Federal Reserve keep interest rate zero, all the central banks around the world keep printing money, gold and silver should always have a place in people's portfolio because, as you said, it's going to be good insurance when the currency collapses. Now, you just mentioned the junior mining and the gold and silver stocks in general. Do you think a lot of the junior explorers are close to throwing in the towel and selling out their companies to larger miners?
Well, I think if they have legitimate assets, but that's few and far between. I think what we are seeing, and I don't follow it on a daily basis, if nothing else for only health reasons because of how bad it impacted me, I would just tell you that we're seeing the inevitable towel thrown in on the companies that were surviving with lights just staying on. We're seeing announcements of consolidations, renaming of companies, the typical things that happen at the bottom of the cycle. But I do think those that had legitimate assets and are worthy are on the drawing boards of majors, and I just think the majors have been sitting and waiting for what they think is the clear signal of the breakout, that they're willing to pay a little bit more for them, but they want to know that the gold and silver prices or whatever the underlying metal may be in what they have is going to hold. We're still at a level in gold that if we went much lower than here, a lot of mines don't work. So I think they're still being a little cautious. My view is that if and when we get above 1,400, that'll give the clear signal to them. I do want to point out, and I think it's something that is not even getting much coverage in what's left of the junior resource market or the mining and metals industry in general, and that is the real rebound in a couple of metals other than gold and silver. One in particular is zinc. Zinc almost traded at $1.10 today after just being, in the low 80s not too long ago. And there is a real fundamental story of not any real new lot of supply coming into the market anytime soon. And, eventually when it, gets even higher and it becomes front page news, they'll start looking at old zinc projects and start, announcing that they're developing them again. But we've seen it there. We've even seen it in copper getting close to 330, which is a level that starts to excite people about, making money in that again. So I think the metals market is one of the few areas, and the energy market, where you can still be a value player and come up with more than one or two selections.
And I agree with you on zinc. That's probably the only base metal I would invest in today, mainly because of the shorter supply that's going to be coming soon, because a lot of the major zinc mine are shutting down, like the Century mine. So yeah, I definitely agree that zinc is definitely something people should look into if they want to invest in the commodity market. But Peter, I appreciate your time. If people want to find more about what you do, where can they go?
Moneytalks.net, one word, Moneytalks, TALKS.net, and you'll see a section called Peter's Content, and that's where I write, and it's all free, and they can register there and get a daily email blast whenever we put out any new commentary.
Okay, great. Well, thank you, Peter.
Thank you, sir.